Look, let's face it, you're probably in this loop right now as we speak, and it's called the trading failure loop. You're watching every single YouTube video, doing every course, joining every mentorship, every signal group that you can. You're trying to do copy-paste strategy, whether it's copy-paste trading through signals, whether it's simply taking someone's strategy and trying to copy it. You're doing this without actually knowing what they're actually doing. And so you're just trying to guess your way through it. But then you wonder why it never works. And what do? Next? You give up. It's a cycle. It's a loop. The trading failure loop. And guys, the reason that you're in this loop, it's not your fault. In fact, it's probably one of the best things you could do if you're starting again from zero. But unfortunately, it's not going to make you profitable at all. That's the truth. So what can you do? How can you actually become a profitable day trader? Well, let me show you a strategy you can use. You're learning a proven, simple framework that makes sense on an institutional level. It doesn't involve luck, hype, or chasing signals, which doesn't wait for 10 or more confirmations to enter the market, and which doesn't predict but analyzes the market and where it's looking to go. And guys, it's the same framework that got me from a broke construction worker with 250K in debt. That's me broke, smiling but not happy, to becoming a multi-millionaire trader that has time, location, and financial freedom. It's called the liquidity trap. So, how does it work? First, we need to understand what we need to make this work. Remembering that it takes time and consistency. Nothing will ever be an overnight success, especially in the trading space. Remembering that you're trading against the majority of retail traders and with the big money that is truly moving the markets to hunt liquidity. You're going to use every time frame from the weekly down to the 1 minute time frame. So your daily, your 4 hour, your hourly, your 30 and your 15, your 5 and your 1. Know your sessions as well. Know when the market is most volatile, London Open, New York Open. Know as well that you can trade during any session. There are peak times in the market where if we can be on the charts, we should be. And then obviously knowing your trading view tools, your horizontal lines, your boxes, and that sort of thing. 2 is your weekly and daily bias. So what do we do? First, we want to mark out your major highs and lows. So your all-time highs and lows, your swing points. Again, highs and lows are going to also line up a lot of the time with equal highs, relative equal highs and lows, resistance levels, support levels, and things of this nature. Ask yourself before getting into a trade or before looking at a bias on a weekly and a daily perspective, where would the big traders' stop losses be? It'll be above resistance, below support, at significant highs and lows. Then what we want to do is mark out our breaks of structure and our supply and demand zones. Supply and demand zones is basically the last push before a big move up. When price returns there, break and retest, supply and demand, support and resistance is all the same thing. They're looking for an entry. Spot crowd behavior. Selling into resistance, buying into a support level. This is where most people are getting into trades, and a lot of the time into trades with the same direction as other strategies. Number 3 is you want to build an intraday plan. So on the 4 hour, you want to remark your swings and equal highs and lows. Also your structure, and check if any sweeps of that have already happened. If they have, great. It could add to your confirmation zones. On the 1 hour, you want to mark out key support and resistance that traders will pile into trades at. Of course, if we have a resistance level that lines up with the supply zone, there's going to be a lot of traders selling there. So we want to mark that out as a key area where there's a lot of liquidity above those zones. Could also be a significant high there. Significant high, resistance level, supply zone. Could even be a trend line buildup, which we want to look to target that. So we know there's a lot of liquidity there. Number 4 is identifying the trap zone. So again, what is a liquidity trap? So basically, liquidity traps are engineered moves which bait retail traders to get into a trade in one direction. So the institutions can fill their orders and move price in the opposite side and take all that liquidity. So you want to look for obvious crowd levels. So things like equal highs and lows, things like obvious support and resistance levels, and false breakouts or fake breaker structures, which are sort of considered like stop hunts or traps in the market. Number 5 is the institutional entry. So you want to wait for the sweep. There'll be a stop run above highs or below lows. You want to look for a counter breaker structure or breaker structure in the opposite direction to make sure that everyone that hasn't jumped in yet but is waiting to are about to jump into a trade. All in one direction, we want it to go the other. So the entry is a retest of a flip zone or price taking out a small support level. Your stop loss, you want to put that just beyond the sweep extreme. And your target is the next liquidity pull. So let me show you my exact thought process behind the actual entry model, which I've just spoken about, this institutional entry and how it works. So here we have the 1 minute time frame. This